you have, this massive private equity pool of capital looking for deals.
Right.
Valuations may come down a little bit, but I don't think the transaction volume is going to come down.
Move over, baby boomers. It's time for Gen XYZ. It's time to stop waiting on the world to change. It's time to be the change. It's time to stop thinking about how your life can be better. It's time to start taking action, massive action to improve your life. Join Zach Winter and Mark Rios every week as we learn how others had the grit, determination, and conviction to 10x their lives, and as we explore ways that can help you 10x your life.
Hi, and welcome to another edition of the 10X for Gen XYZ podcast. I'm Zach Winter.
And I'm Mark Rios.
And today we want to talk about businesses, and specifically when people think about owning their own business, most of the discussion is on the birth of the business. What kind of business are you going to start up or buy? How do you go about doing that? And then there's a fair amount of discussion about how to grow your business. But what happens after you've built up your business to be a successful and thriving business and you're looking to retire? You probably want to cash out and sell your business. But how do you go about doing that? How do you know what the business is worth? What can you do, if anything, to increase the value of your business before you sell it? How do you market it? How do you find the right buyer? And so today, as our guest, we have Kevin Berson. He's the founder and president of Kinected Advisor. And that's an advisory firm that helps business owners sell their business, position it properly so that they can maximize the value of their business. Kevin, welcome to the show.
Thank you for having me. Excited to be here.
Yeah, pleasure. So Kevin, I want to go back to kind of the beginning of your career and the path that led you to founding Kinected Advisors. You got your BA from UCLA, then you got your master's from the Marshall School of Business at SC, fight on. And take us through a high level of your career path and kind of what led you to founding Kinected Advisors.
Yeah, it's really interesting, and it's definitely a non-linear career path, and it really didn't make a lot of sense to me until about 5-6 years ago. So I got my first job out of UCLA at Arthur Andersen in business consulting, which was just an incredible first job out of school. You're 21 years old and they're throwing you into a new client, a new industry, a new part of the business, and you're just expected to figure things out. You're part of a really high performing team, and it's a really great team. It's a work hard, play hard type of environment. And if you kind of do well, you can progress pretty quickly and get more responsibility and take on bigger roles. And I was initially thrown into a group they were implementing computer systems for manufacturing companies. So I learned a lot about supply chain, and never would consider myself a really hardcore technology guy, but I understood enough about systems to really understand how businesses can use them for a competitive advantage. So this was like during the Y2K boom in the 90s, and there's this huge push to modernize computer systems. And I was on several projects. The first one was with Oakley Sunglasses, a really fun, interesting client. And then we had a really great team. We rolled on to a couple different projects. We went on to Mitsubishi, and we went on to a medical device company. And I was just having a great time in Andersen, progressing through the ranks. And then all of a sudden, 2002 rolls around, and we hear about this Enron scandal out of Houston. And, Arthur Andersen is a 100-year-old company of, great reputation, 100,000 employees around the world, premier big six firm. And then all of a sudden overnight, basically they, were convicted or accused of some kind of unethical dealings in Enron, and they lost their ability to perform audits. And the whole company, went under pretty quickly. It was a pretty chaotic time. But it ended up being a great thing for me because my network just exploded and went everywhere. And I was looking around for different roles, and I was recruited to go to Technicolor, which is a $5 billion entertainment and manufacturing company based in France. And I went in there. They were looking for somebody to head up their worldwide SAP initiative. SAP was a system that I worked with. And they made a deal with me. And they said, you know what, I know you're enrolling in your MBA right now, but we need you to not do that. We need you to go down to Mexico for a year, go down to Guadalajara for a year, and run this project for us. We're going to give you a team from IBM to help you out. We're going to give you a $5 million budget. And you finish this project on time, under budget, we'll pay for your MBA. I'm like, well, that's a pretty nice deal. Like, I got to do that. I'm single at the time. So I went down there and stayed down there, probably half time, and flew back the other half. And really stressful project, but it was just a wonderful experience for me. Got a lot of leadership experience and enrolled in the USC EMBA program. Started taking finance classes, became very interested in finance. I had really no finance experience. And at the same time, Technicolor had a new CEO that was looking to have a very aggressive acquisition strategy. So he created a small team of investment bankers. I was initially on that team as the IT guy looking at companies that we might acquire. And then they offered me a full-time position. They said, you need to leave IT, join our team, and it'll be a good experience for you. And it was an incredible experience. So I went into M&A with really no finance experience and just a good attitude and willing to work hard. And it was the most fascinating work I've ever done. I fell immediately in love with the M&A process. It was just completely fascinating to me, the level that these people think, these investment bankers, the level that they think at. I'd never been exposed to this before, where they, within the course of like 2 weeks, could put together a 50-page deck about a business and understand everything about it. The management team, the drivers, the margins, the product line, the competitive landscape. And it was just fascinating. So I was part of that team for several years, and we started out doing a 6-month strategy project. We were looking at digital advertising and the role that was going to play in our lives. And we start to see these, flat screens in airports and fast food restaurants, and they've just kind of LED advertising just kind of taken over everything. So we built a strategy, and then we went out and bought 3 companies for one was $285 million, another was $40 million to fulfill this strategy. And it was just so exciting, just to be a part of these teams and to be a part of this. And I got really good at, I learned a lot pretty quickly about how to value companies and how to tell the story of how this is going to make sense. So we did a lot of work on the buy side, and we did a little work on the sell side. And we sold RCA, which is a famous, iconic American brand, doing about $1 billion in revenue at the time. And I was also getting my MBA at night. It was just a crazy, crazy time. I was working, literally 90 to 100 hours a week while getting my MBA. So I was really burning the candle at both ends. It was not going to be sustainable for me. And ultimately, I decided that I needed to move on to a different environment. And this was just incredibly exciting for me and great, but it's just, these guys are always going to be working at this pace. It's just kind of what that job is. And some investment bankers are just kind of wired like that. I am not wired like that. I have a family now, and I have hobbies, and I like being outside. So that was just not going to work. So 8 years ago, I just decided to leave Technicolor and go out on my own. And I was pretty confident that I had a pretty good skill set of consulting and M&A and strategy. And I wasn't exactly sure how to put that into play. But I set up Kinected Consulting, and I started leveraging my network to go get meetings. And I started helping companies with business plans and financial projections. And so my network kind of got me a couple of really great projects. I got a great strategy project with Beachbody, which led to a couple other projects. And then I started to join some networking groups. I joined Provisors. I joined Bruin Professionals. And all roads started to kind of lead me back to M&A. And it wasn't really what I expected to do, but I started to meet this small business owner. And, this is a business owner that's typically doing, 5 to 50 million in revenue. And they have these businesses that they've built up over decades. And, a lot of them are baby boomers looking to retire. They're in their, 60s or 70s, and their kids are, not typically interested in a lot of these businesses. They're, aerospace parts and commercial printing and packaging and environmental consulting. And, these are just kind of traditional businesses that a lot of the kind of second and third generation, fourth generation just wasn't really interested in going into. So it's pretty rare that these businesses would survive. So these business owners have these assets, and they want to exit, and they want to realize some of the value, but there just isn't there aren't a lot of professionals that work in this market. I feel like it's an underserved market. A lot of people I speak with don't, a lot of business owners don't know how to navigate this. So I started to meet a lot of these business owners, and over the last 8 years, we've kind of built a nice business working with these business owners and helping them exit on their terms. And it can be very, very fulfilling to see the project from start to finish.
Great. That's great. Yeah, we, there's an interesting parallel, at least with some of the stuff that we've seen on generational real estate on our end, because you kind of have the same thing. Sometimes you have older folks, sometimes they're partners, and they're getting up there in age, yet the kids don't want to have anything to do with their massive real estate portfolios. And, at a certain point, they have to exit those properties because, the younger folks just don't want to do it. Yeah. And, that's very cool, and there's a huge, just from the buy side, there's a really big kind of push with younger people, millennials in particular, but probably some Gen Xers right now going on, looking to purchase businesses. Maybe not as big as where you're playing, but a lot of people are. And there was also some gurus out there that are teaching this, which is very interesting too.
What I find interesting, Kevin, is, when I go to the internet and look at businesses for sale, it looks like it's mostly like lower level business brokers who are dealing with selling lower and middle market businesses. And what I find really interesting about your firm is you're taking your experience from a much higher level, multi-million-dollar mergers and acquisition, and you bring a kind of a level of professionalism that I'm not seeing out there on these business brokerage websites like BizBuySell or BizQuest, et cetera.
Yeah, that's exactly right. That's exactly what we're trying to do is, my team, we all have significant kind of bigger deal experience. And I see a void in the market. There are lots of investment bankers out there that are, commonly doing $200 million deals and above. And there's a lot of business brokers that will take kind of Main Street type deals. And, these are businesses maybe doing 100,000, a couple 100,000 in revenue. Those businesses are very, very difficult to sell. This is a generalization, but and I see the same problems. Their books are not in great shape. So a buyer doesn't really understand what the business is and the real cash flow that it produces. So I find when you work with businesses that are a little bit larger, maybe like 5 million in revenue, that's when they start to have a little bit more infrastructure. There's a little bit more of a story. There's a little bit more credibility. There's more stability in the business. And they're more likely to invest in infrastructure like a financial function to help them with this. So it's an easier transaction. It's an easier process when the seller has the funds to kind of put in the resources to professionally present the business. There are business brokers out there that that kind of run their game is they're trying to run a volume business. They take listings. They, some are very good. I have a lot of business brokers that I refer deals to that I respect. But yeah, generally those guys and gals are playing a volume game where they try to get 10 listings and sell as many of them as they can. I am looking for, 2 to 3 good companies a year. And that's what my bandwidth is, to really do a great job and put my full effort into these businesses and run these processes, because these deals will generally take at least 1,000 hours per transaction,
Sure.
From start to finish.
And so you're doing 2 or 3 deals a year. I took a look at your team and I thought it was really interesting because they come from a very diverse background. You have an attorney, a CPA, you have somebody with expertise in human resources, you have 1 or 2 people that have expertise in coaching executives. Are they all getting involved with each client, and how does that interaction?
No, these are folks that I've worked with in the past that I kind of have on speed dial, and I'll bring in different folks for different needs. These are the kind of the top needs that seem to emerge on many projects. There's often kind of workers' comp issues or employment issues that need to be dealt with. So we need an HR consultant. Every transaction, they need the seller needs to have a great CPA, or better yet, a CFO behind them that's kind of really understanding the business and will represent the business to the buyers. Because often the seller, the owner is involved in all aspects of the business. They're not a trained CPA, and we need to speak the language of M&A, which is accrual, GAAP-based accounting. Our books need to be compliant with generally accepted accounting principles to sell any business at any kind of meaningful value. So the finance people are my top referrals that I bring in. And then every business I highly recommend they have a very good corporate attorney as well that really understands M&A. I'm working on a deal right now, and the attorney that they were working with before me was an intellectual property attorney. And I saw some of the agreements that were written. I'm like, these are just not good agreements. Like, I am very confused on what this is trying to say. So ultimately, it's going to be very difficult to sell a business with these existing contracts in place that are very subject to interpretation. You really need to have an attorney with some strong corporate and M&A experience, and you really want somebody that's all they do. So they're really going to understand all the M&A terms. They'll understand what's a reasonable position. They'll understand where market is on different terms, and what an aggressive position would be and what a reasonable position would be. And you really need somebody with that kind of training and experience on every deal to represent the seller.
So, well, walk us through the process of, say I'm a business owner and I'm thinking about selling my business. What's the process when you go and meet with them, and what types of things are you working with them on? You mentioned getting the books in order. Yeah. What other types of structures and procedures and policies and staffing do you work with them on?
Right. So the first step is I want to really get to understand the business. What is the business? How do they really make money? I'm asking myself, how sustainable is this? How critical is the owner to this? Can this thing survive if the owner was to not be here? Because ultimately you got to put yourself in the shoes of a buyer. I'm thinking of, like, what does the marketing presentation to the buyer look like? How am I going to convince a buyer that they should pay a premium valuation for this? So I have a checklist in my head of things that I'm going through. So the first thing I want to do is I want to understand the financials of the business. And generally, the business owner will have a number in their head of what they think the business makes, and a number in their head of what they think the valuation is. And often those numbers are disconnected from reality. I've often a seller will say, well, look, I spent all this money on marketing, but my marketing really wasn't effective. So we should add that back because we're not going to do that anymore. Well, no, that's not how a buyer would look at it. Businesses, depending on the business, will have a reasonable marketing expense. So you should be trying things in marketing. A lot of examples of that. So what I'm doing is I'm looking at the financials. I'm really going deep enough to normalize the earnings. So really looking at, what do the sellers pay themselves in salary? Do they not have some things that they should have in this business? Are they underinvesting in finance? Are they paying themselves fair market rent if they own the property? This is a big one. A lot of these business owners have acquired their properties and they're either paying way above market rent or way below market rent, depending on what their preferences on taxes. So we have to make adjustments there. So we're really getting into the numbers, understanding what the true cash flow is. And then I'm doing some research and I'm giving them an industry multiple. Different businesses sell at different multiples. And I'm coming up with a range of, I think your business is worth 10 to 12 million. Is that a good number for you? Is that a number that you can retire with? And then at that point, that sets off a whole other stage of discussions. And we may bring in estate planning attorneys. We may bring in wealth managers. We may bring in some other people to help them ask these questions, because I'm really looking for three things to happen when I'm selling a business. The business itself needs to be performing. It needs to be performing well. The owner needs to be psychologically ready to transfer out. So I'm looking for them to have other hobbies, activities. If they are married to their business and really don't have other outside hobbies, it's going to be a tough sale. They will, if they're not truly ready, they may find ways to sabotage the deal, and we're all going to waste a lot of time. They need to truly be ready. The business needs to be ready, and they also need to be financially ready. All three legs of the stool have to be satisfied. So I'm looking for that when I'm qualifying businesses. I'm also looking for a business with a diversity of customers, a diversity of suppliers, a diversity of employees. I'm looking for a favorable macro environment. I had a great experience last year with a plumbing services company. And, this is a business proved to be pandemic resilient, right? If you have a plumbing problem in your house, you're going to call a plumber. You don't really care what it costs. You have a problem you have to fix. And the pandemic was good for business, frankly. More people at home, more pipes were getting clogged. And it was, that proved to be a great business in a really great macro environment. I'm looking for businesses I think are going to be, not so cyclical. I'm looking for businesses that have kind of favorable macro environments too.
When you're just to ask a question on that point, when you're looking for these 3 points, when you say you're looking for those, are those your criteria in terms of whether or not you choose to work with a company, or do you go in and try to fill those gaps in to kind of adjust?
Well, yeah, that's a great question. Ideally I have all 3 legs of the stool, but I'm also looking for, sellers that I feel like I'm going to be able to work with. And if there's any things that are missing, that they're open to feedback, they're open to talking to other experts, and they're open to working on these things. So I love to get involved like 1 to 3 years before the business is ready to sell. That way we can work on a lot of these items, and we can set up a process in place where I give them a baseline valuation, and then we can track the readiness over the next 1 to 2 years and see if they're ready. And by being ready, it's, are all your contracts up to date, and are they going to be transferable? Do you have, key employee contracts? If you have like a customer that is dominating your sales, maybe you have a customer that's generating like 50+% of your sales. Well, that's going to be a problem. A buyer will not pay you full value for that. I had a meeting this week, and it was kind of a painful meeting. Seller has a great janitorial services business. He's doing about $2 million a year profit, but his top 2 customers were like 85% of the sales. So I spoke with potential buyers about it, and they said, we would not be interested. It's just too much risk for us to take on. So these are the kind of things that need to get dealt with before going to market. There's a lot of other items, if there's any open litigation that needs to be dealt with. The business, you just want it to be, you want your presentation to be as bulletproof as possible, because you really get one shot. You get one shot to go to market with your best effort. So there's a lot of factors that go into it.
Right.
Is there a certain income to expense ratio that you're targeting? So we do some benchmarking of how the company is relative to its peers, and you want to see that their margins are in line or better than their peers. If there's not, then something is out of whack, and that buyers are certainly going to see that, because buyers are smart, and the buyers I work with they tend to be private equity and strategic buyers that know these businesses very well. That's another big difference between kind of the business broker world and the M&A world that I'm in, is in the business broker world, the buyer is typically an individual, typically for $2 million transaction value and under. And in my world, the buyers are private equity or strategic, and the private equity folks, they know the space very well. They study it. They have very smart people, and they're generally looking for add-ons to companies they already have. So they're looking to, basically expand their footprints.
And so on that point, just real quick, even though you're not acting as a broker, are you the one that kind of makes the call to your contacts in private equity? Like, hey, these guys are getting ready to sell in the next 6 months. You want to take a look?
Yeah. So I actually, like, the term in my space is kind of, M&A advisor or intermediary. So I am acting as the broker.
Right.
I will represent the seller only. Don't really, I've been in kind of a dual agency scenario a few times on smaller deals. I don't prefer that kind of structure. It has happened before, but it's not what I seek to do. So I'm seller only representation. And what I want to do is get the business very ready, packaged properly, wrapped around with the right marketing materials. And at that time, then we go execute the marketing strategy. And while I'm preparing the business, I'm also making a list of potential buyers, sometimes even previewing the business with buyers. Hey, I have this type of company coming on the market. It's 10 million in revenue. 2 million EBITDA. It's in this space. The customers are in these segments. I'm not giving anything away, nothing proprietary at this point. Would you be interested in something like that? What are your thoughts on value? What's the data that you need to see to be comfortable? So I'm kind of doing this previewing while I'm getting the business ready. So when I'm ready, I know I have kind of some receptive buyers.
Right. And are you, when you're kind of going out to those people, I'm assuming so because you have such extensive experience, but are you typically, I guess, talking to kind of C-level type people or VPs, or like, what's your entry point, especially with groups that you don't really know? Like,
yeah, that's great question. So in the last few years, it's been mostly private equity dominated. And, the reason for that is private equity has just raised so much capital over the last decade. I mean, it's like $1.5 trillion that they need to deploy. And because things were slower than normal during COVID for a lot of industries, a lot of this capital didn't get deployed. So these private equity firms are very aggressive for more deals, and they've really come down market. I think years ago, they would only look at a company if it was doing like 5 million EBITDA. Now they'll look at anything like 1 million EBITDA and up. So they've come down market. They're very aggressive. They know what they're looking for. They're very educated buyers. So my entry point there is the business development person at a private equity firm. That's the most common target. Or if it's a strategic firm, they generally have a head of corporate development.
Interesting.
Or the CFO are good. But sometimes I'll go directly to the president too. I'll when I have a listing, I will find a way to get to the right person, whether it's through email, LinkedIn, phone calls, mutual friends. We can get to people. We will generally send them a teaser, which is like a 1-page document that presents the business. And at that point, I'm looking for a quick yes, no, maybe. Yes, I'm interested. I want to learn more. Send me the non-disclosure agreement, or no, we don't like this profile. That's great. I'll move on to the next one. Just a quick no is great. Just let me move on. But so we work the list.
How do you deal with business owners who have a primary role in being the rainmaker, bringing in new business?
Yes, that's a challenge. That's a real challenge. So when I have that scenario, sometimes the business just isn't going to be sellable. And I spoke with the gentleman this week. He is in the world of internet advertising, and he is the rainmaker, and this business is doing incredibly well, but he is the brains behind this thing. And I don't really see a scenario where a buyer is gonna buy this business and let this guy go. So I don't. So in those scenarios, I'm looking for depth. I'm looking for what's the transition plan here? Can we tell a credible story here? Is there a transition plan? How what exactly is the seller doing? Like, what does that seller's day look like? How much are they working? If they're working 50, 60 hours a week, how replaceable are they? I would like to see a transition plan underway before we, if the person has that profile where they are the rainmaker. First of all, a buyer is going to scoff at that, and they're probably going to pay a reduced multiple. A. B, the offers that we get are going to be probably back-ended. And by that, I mean the seller's most likely not going to get a huge percentage of the deal value up front. There would probably be an earnout, where basically the business needs to continue to perform at a certain level for the seller to get that non-cash component.
Is the seller continuing to be involved in bringing in the business during that earnout period?
I would say the seller is going to be needed to do that. Yeah.
Because then it seems like there's an incentive for the seller to continue to stay involved to maximize their earnout. But as soon as the earnout number is determined, they back off.
That's right. Yeah, that's right. And those just become very complicated, these scenarios, because the buyer, sometimes they have a different philosophy on running the business, and they think that more costs are needed, and therefore the earnings might get reduced. It's often hard for an entrepreneur when you have your own business for 10, 20, 30, 40 years to have a boss. Yeah. So these are challenging situations, and I am most likely not going to take a deal if I think the obvious route is an earnout. It doesn't feel good to negotiate these deals when you're getting sellers, 40, 50% of cash. That just doesn't feel like a great outcome.
That brings
Let's-
up, I mean, that it also kind of violates your rule number one, right? Like the Rainmaker should be aware that he's going to have a hard time selling it because he's the guy. You know what I mean? And
Yeah.
so it's kind of like, well, you got a couple choices. We're 3 years away from you selling if you train somebody. You know what I mean? Like who's next up? Who's next up to bat?
And that was,
you know,
and that
to
was the
help?
exact conversation I had this week with this janitorial services company. It's like, let's get you a right-hand person. Like, you are the Rainmaker. You have no management team. Guy's super stressed out because he's doing everything. Let's get him a COO. Let's get him somebody else that can help him run the business. So to free him up to get other sales and take a lot of he still runs payroll himself. I mean, that should not be happening in a business this size. So yeah, we got to really look at the roles and, what we could get today. I do like a comparison of, let's say you were to fix this problem and have some bench strength, get some additional sales to diversify your business, then we can get you a much higher value and a much higher percentage of cash at closing. So I try to make that case as well. And, sometimes we'll bring in the CPA as well and say, look, here's what your proceeds look like after tax as well. So you really can make an educated decision.
Yeah.
A lot of times when people start their own businesses and it's going well, you'll have family members that'll join the business, right? And sometimes they'll take on leadership roles. But what's your approach with evaluating how to deal with that?
Yeah, that's also very delicate as well. I mean, sometimes the family members and there's a lot of issues to consider. Like, are the family members likely to stay post-closing? So that's a big if. If they're in key roles and they're not going to stay, that's a problem. That's a transition problem. A lot of times you see family members that are paid way above market. And that's a problem if they want to stay, or if they're paid way below market, then we have to adjust the value of the business to reflect what a similar person with a similar skill set would be. So there's a lot of issues with family members. A lot of times, you see owners will kind of have their kids on payroll and they're not necessarily in the business. So in those cases, we just need to prove to the buyer that, look, this is not a role that's being played today. So it really is an add back. Mm-hmm. So that you would get that cash flow that is being spent on those resources today. So it's really just about, putting yourself in the buyer's shoes and how's the buyer going to look at this dynamic and what do you think the buyer is going to do? So it's challenging. There's definitely many different things to look at with that.
Yeah.
Do you mind if you just real quick get into the weeds on kind of that?
Yeah.
Because it just brought up a thought in my mind in terms of, so just real quick. So typically, are you guys on an LOI kind of process where a buyer will come in and say they've looked at the financials and say, you know what, non-binding LOI, this is probably what it looks like, and then you start getting into the kind of the due diligence part of it, correct?
That's right.
And when you were just talking about add backs, and I'm assuming that I guess the negotiations on that part of it come right after that LOI when they sit down with you and the seller and some buyer's representative or the buyer, and you guys start going through the income statement, and you're like, look, this employee's the daughter-in-law, and she's getting paid $30,000. It's a $75,000 a year role. We need to normalize that. Is that kind of the process where you're doing all of that to settle on I'm working with the seller up front, and I have to make a very strong case initially for here's what the normalized earnings, here's what I think we are. Right.
I might tend to be a little bit on the aggressive side and say, look, we can argue for this. It's a little aggressive. Do you want to argue for that? We can, but don't be surprised when the buyer comes back and whittles that down. Here's where I think we should end up. Here's what I can defend. Here's what I have, your credit card statements to be able to show that you bought the $10,000 mattress, that wasn't a business expense. I can show that.
Right.
But yeah, once, ideally we're having a competitive process. So we have many offers up front. So once we get to the point where we have the LOI, we have the party that we want to work with, and generally we're going to go exclusive with that party at that time, mm-hmm. and really try to close with that buyer. So once we sign the LOI, essentially the power shifts to the buyer, and now the buyer comes in with their diligence team, looking to kick the tires on every number that we've presented, and they're
Right.
looking to come back and basically look for reasons to reduce price.
And so we're in real estate, you know this, I'm sure, but
Same thing.
yeah, it's the same thing. And so when we go under LOI, we do our due diligence, but typically, and this is just gamesmanship, but we typically hold back until closer to the end of our kind of what we call going hard period, right?
Mm-hmm.
On our earnest money. And that's when we kind of hit them with what we call a retrade, right? Like things that we saw during diligence that we didn't either expect or that we want credit for. Is that kind of the same process, or are you guys?
Yeah, the term retrade is a really negative connotation.
I know, totally. I know.
In the industry, and I basically, to me, a retrade is when you change your mind on based on no new information. If I give you new information that the situation has changed and the earnings are no longer this because we've lost this customer, well, that's fair. That's fair. You have every right to change your valuation there. But if everything I told you is legit and then you change your mind, that's not cool. That's a retrade, and that's where we're gonna have a problem, and you're gonna lose some credibility with me. Sure. I expect you to be at face value, and if everything I'm saying comes out to be true, you need to honor what you gave me as well.
Sure.
And I've been very fortunate with that. I've worked with very high quality private equity firms that have not retraded on me, but I know it does happen.
Yeah. And we don't retrade. When we go into due diligence, if we ask for a reduction, it's based on new information.
Right, exactly. And then that's fine. I mean, that's the whole point of the process. And also time passes, right? And what happens with time? I mean, situations change and Omicron hits and customers come and go and employees come and go and the market shifts. So like time is one of the ultimate deal killers for sure.
Speaking of timing, what's the typical time frame once you've positioned the business, gotten it ready to market? What's the time period to market? And then what's the time period that once you go under LOI that you're in escrow before you close?
I like as a general rule of thumb, I think we need about a year. A year is basically the time that the deal is going to take. So that includes, after I sign my agreement, I'm going to work on the marketing materials, and that's about a month. Really to get in there and understand everything. About a month, work on the buyer list, the teaser, make sure we're ready to go with our non-disclosure agreement that the buyers are going to sign. That's about a month. And then 2 to 3 months to go solicit buyers, find buyers, get initial offers. And then from that point, hopefully we know who we like. We have initial offers in, probably about a month to get to the LOI. And then from the LOI to close is typically about 3 months. So I don't know where we're at on that. Maybe it's 10 months, but 10 to 12 months is kind of the typical range. And these deals take a long time.
Yeah.
They take a long time. There's a lot of dependencies along the way. The process moves fairly fast up until LOI. And then, the attorneys get involved. The attorneys tend to take time. And then once the LOI is signed, then the buyer is going to bring in all kinds of diligence teams. And those people right now in the M&A world, the diligence financial folks are really backed up. There's a shortage across the country of people that can do these quality of earnings projects. So there's a backup there. And then once all the diligence is done, then a lot of times the buyer will go out and get the lender. Their private equity firm already has the equity piece, but they like to get some kind of subordinated debt. And then that takes its own diligence process. The bank's going to do their own diligence. So there's just a lot of links in the chain.
Talk to us a little bit about the debt. Like I know on these like lower market level deals that you see on these online brokerages, a lot of times the buyers are looking to try to get some type of SBA financing. But when you're dealing at the level that you're dealing with these types of buyers, what does the debt look like?
So a lot of times these buyers already have kind of large, lines of credit that they can use. We had an amazing result with a buyer a couple of years ago in 2020. Did a 9-figure deal on an e-commerce business, and the buyer had, they had their equity piece, and they had to go out to the market to find a lender. And it was pretty tough to find a lender in apparel during COVID. And the company that we sold is also an alternative brand. So the website had, was definitely people had a visceral reaction when looking at the website. So it was a little harder to get funding for. But that's generally the model of the private equities. They'll put in I forget the exact mix, but it was, a reasonable amount of debt that can be easily serviced by the cash flow of the business. They're not looking to take on excessive debt, but a little bit of debt was, they were looking at the kind of the optimal capital structure for the deal. And it's generally, something like 60% equity, 20% seller rollover. So private equity likes the sellers to have some skin in the game. And this can also work out very well if private equity goes to sell the business again. And that, 20% rollover could be worth a lot, could be worth more than the initial amount if private equity sells the business again, which they try to sell the businesses within like 5 to 7 years typically. And then
tell me a little bit about that. So the 20% rollover is basically the seller putting in essentially a promise, loaning the buyer 20% of the purchase price.
Or just keeping equity in.
Yeah, like on a hypothetical $100 million deal, maybe the buyer's putting in $60 million in equity, 20 million of the seller's 100 million will stay in the business as equity. So the seller owns that piece, and the last 20% might be the subordinated debt that comes in.
But it's not really an earn out. It's really just keeping their piece in, and it gets paid when they go to sell, or if they refinance the debt or something like that.
Exactly. This is not earn out. This is just rollover. It's called rollover equity. So the seller has some skin in the game. They're going to be, heavily motivated to continue to help the company and, do what's required. And then hopefully, there's a big win for everybody the next X years down the road where that,
everything's negotiable, but I assume the seller's putting in some provisions about like how much they're going to get each year on that rollover and what the longest is he could have to wait to get paid back.
Yeah, I mean, it's a risk. It's a risk, and there's no telling, like the market could shift, but there generally is like a preferred return that comes back on that equity, a market, above market kind of interest rate. But that's really, then it's really the sellers are not really in control of the process. Right. It's the buyer that's in control, and they determine the right time to exit.
And so are they what like this is very interesting to me, but what part is the seller in terms of the loss piece, loss order, right? Where are they? Because usually not all equity is equal. Right. So I'm assuming that the private equity guys, they're going to lose their piece first before the seller gets hit because they have a preferred return, or is it all kind of pursue?
I mean, it gets pretty complicated, and we definitely, generally there's different classes of stock, and the private equity is going to be the top tier, and then it's the seller rollover might be, hopefully we can get it in the same class. Sometimes it's a subordinated class, but it's still going to be, it's probably going to be most likely in the LP kind of status.
Understood.
Yeah, that would make sense. Really interesting.
I got just a quick question. I don't know why I had this thought, but I was just thinking about how we kind of approach, value add deals. And part of it is, for us on real estate, we like to force appreciation, but that also means that enforcing appreciation means actively doing things to increase the NOI or EBITDA in your world. Yeah. And so I'm wondering, are there ever, because it sounds like you come in and you're really trying, part of your job is to take away a lot of the objections that a buyer might have. So really presenting this fully functioning, amazing opportunity, let's call it, or business. Whereas sometimes, when we're buying stuff, especially for value add guys, we want there to be some inefficiencies. We want management to be bad. Do you ever encounter that? And is that only really in maybe a situation where the seller's just trying to get out and they say, just tighten up the timeline. I want this sold in 6 months, whatever price you can get for it, boom, done.
Yeah. I do get that scenario from time to time where sellers are just like, look, I'm done. COVID was a wake-up call for me. There's more to life than my business. My most precious commodity right now is time. I have enough money. Just get me a fair price. I certainly get those from time to time.
Yeah.
But to your other point, the buyer, there needs to be some meat on the bone for the buyer.
Right.
There needs to be something there for the buyer to do. If we're asking like a super premium, the seller has a super premium expectation, a lot of buyers, if they feel like they can't add value, then it's probably not going to be a great deal for them.
Yeah, that makes
So
sense.
you may lose a part of the buyer pool, by having too high of an expectation. But yeah, it's a good point. But yeah, basically buyers are looking for value add for sure.
Yeah.
They're looking to buy at a 1 multiple and add value and then sell it at a higher multiple.
Are these buyers, it sounds like some of them are looking to add to existing businesses growing. So as part of the value add, they're consolidating, figuring out where there's overlap in terms of employees.
Exactly. So I talked about a plumbing company that I had a great experience with last year. So the buyer for that one was a private equity firm that had a portfolio company that was like 10 times the size of our company. And they had done last year 4 or 5 add-ons, like similar size to ours. And they're looking to add in, they're going to systematize the whole thing, put in consistent systems, a management layer over it. They're going to get equipment, negotiation savings on equipment and parts. And they're just going to add as many kind of multiplier effects as possible to kind of leverage these positions. So, I was surprised when I went to market with this, there was like 25 different plumbing roll-ups happening all around the country regionally. So, we participated in a Southern California one, but, they're happening on the East Coast and Southeast as well.
That's interesting. Yeah, I guess really it comes down to, in that part, it really comes down to they're trying to jump into a market that are in a situation that already has market share in certain areas, right? So they don't have to go through the whole process of starting from scratch.
They're finding quality businesses that they can kind of plug into their model and just make the whole platform that much better.
Yeah.
Bigger and better. It's a pretty common private equity strategy, and it's just kind of interesting to see it in the plumbing industry.
Now, are you still doing your 90 hours a week, running your business now?
It comes and goes, but it's never been 90 hours. I guess maybe if it's like the last couple of weeks of a deal and you're in the heat of deal, maybe it gets like that. But no, I'm pretty content. I'm working on a few deals right now. The workload kind of comes and goes, but I have a lot more free time. I am able to kind of spend time with my wife and my kids. We just took a trip to Kauai. We're planning a couple other trips this summer. We're going to go to Yellowstone. I've been playing a lot of tennis, which has been great. It's kind of a rediscovered tennis during COVID. Joined a club and have been playing a ton and playing in tournaments and USTA. So I'd like to think I have pretty good balance. I definitely could probably do a little bit better. I definitely, my projects, I'm always thinking about them, what I could be doing to move things forward. Yeah. I'm sure like anybody, but it's a little hard for me to kind of shut it off at night. Yeah. But I definitely feel like I'm on the right path, and it's very rewarding when you meet this business a couple of years before they're ready to sell. You work with them, they listen, you bring in the right team to get this thing ready, and then you have a great process and you close it, and then you sit down with them a couple months after closing, and they just are so happy. They're so happy. And you help them solve this huge problem, something they've been thinking about for years. And the last few, we've had just great results, which have exceeded sellers' expectations. And it's just, you have a friend for life and a fan for life.
That's awesome.
That's fantastic.
And it sounds like also, if I remember correctly, when you were working at Technicolor, you actually made it through the Great Recession while you were working at Technicolor. Is that correct? Or were you
I did. I was kind of like, I went through like peaks and valleys of Technicolor when I was really happy for a lot of time. And then, the recession hit, and I just kind of like felt like there weren't going to be a lot of other like great opportunities. So let's just ride it out. And, I was at Technicolor for 11 years. And anytime I kind of was in a role that kind of felt like I needed to change, I was able to make a change. So the company was really good to me. It was a great training ground for what I'm doing now.
Yeah, I was going to ask. So in terms of your kind of outlook in the future, especially the immediate future, are you obviously going to draw from some of that experience, hopefully, but are you making any adjustments in your consulting with these business in terms of the possibility of a recession or a slowdown or anything like that? Like, what's your outlook?
Yeah, I think, look, we're all feeling like the immediate hit of kind of the interest rates settling in. I think the immediate effect for M&A is it will be a little bit harder for businesses to get the debt. The debt piece is going to be a little harder to come by. I think in the near term, it's going to reduce valuations a little bit. I still think the M&A wave in this market, the lower middle market that I'm in, it's going to continue. I mean, there's just the macro environment. I forget the number of business owners that need to, the baby boomers that are retiring. It's like 10,000 a day. It's some crazy number of business owners that are retiring that have these businesses that will be transitioning out of these businesses. And at the same time, you have, this massive private equity pool of capital looking for deals.
Right.
Valuations may come down a little bit, but I don't think the transaction volume is going to come down. I think there are good businesses that are out there. There's money out there finding them. The marketplace will continue to be efficient and foster deals. So I'm just looking for quality companies that are going to survive, that are still going to do well in a recession. I mean, that's what I'm looking for, companies that can hold up and aren't so cyclical.
Yeah,
so that's the holy grail for me, is just being very, very selective. As it is, I'm probably taking one in 5 or 6 deals that I talk to. And I just got to continue to be very selective and only, really work with the best quality companies and keep doing that.
That's great.
Interesting. So if somebody has their business and they're approaching or thinking about potentially selling, what's the best way to get in touch with you? Yeah,
they should send me an email. My email address is Kevin, Kevin, at Kinected, Kinected.com. They can check out my website, Kinected.com, and or hit me up on LinkedIn. Those are probably the best ways.
And do you ever take on like interns, or you ever teach them stuff too?
I do. I've had amazing success working with some USC interns. I'm a UCLA loyalist for undergrad, but there's a USC investment club at USC undergrad, and I've gotten 4 or 5 like world-class interns.
Awesome.
It's really great. Great people I've stayed in touch with. It's been really good.
Cool, man. Well, this has been fantastic. Very, eye-opening. I could sit here and chat with you about this. Maybe we should put together a mastermind and have you get up there and teach this stuff.
Let's do it. I've always wanted to join the mastermind. I've always wanted to do that. Yeah, let's do it.
I love it. Well, thank you, man. Really appreciate it. And, we'll definitely be in contact after this, and maybe we'll do a follow-up down the line.
Yeah, sounds good. Thank you so much for having me. Your questions were great. I really enjoyed the discussion, and thanks again for having me.
Awesome. Thanks, Kevin.
Thanks, Kevin.
Take care, guys.
Bye-bye.
10X for Gen XYZ is hosted by Zach Winter and Mark Adair Rios, co-founders of Prosperity CRE, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and building long-term wealth. If you like the podcast, please give us a positive rating and subscribe to be notified about future content. Also, if you'd like to learn more about our approach to real estate investing, you can download a free copy of our real estate investment book, Investing for Cash Flow and Long-Term Wealth, by clicking the link in the show notes below. Thank you, and stay tuned for our upcoming episodes.